2025 is the year when gold started front running what are inevitable developments in the dollar. I think that probably puts it in a nutshell, and it creates, if you like, the background for what we can see in 2026 and 2027. The geopolitics as well, the ups and downs of trade, discussions, hardly discussions. I think that global trade has been screwed, really, by American policy, which has vacillated one way and the other. The relationship between America and China as well, I think, is a big, big topic, and it's led China, I think, to take some very serious decisions to protect its own resources. So, we've got silver. That she stopped supplying silver automatically to the rest of the world, which was what was depressing prices of that. There is absolutely no doubt. So silver has taken off, and I think there's a growing realization that it's not just silver, but China is actually a major source, global source, processed rare earths, antimony, cobalt, all these things which are needed now. So the entire base metals sector, or basket of them, has actually begun to move up. So we're beginning to see inflation, which so far is not being discussed at all in monetary circles. And I think that is interesting, and I think it's irresponsible, actually, to just sit on that story, which is really what the Fed and other central banks have been doing, other G7 central banks. So quite a lot to talk about in that sense, but I think also we need to look forward to what's likely to develop in 2026 and 2027, particularly the Fed has given up on trying to control inflation. The official story is inflation is no longer a real problem. Okay, it's 50% above the desired level, but we're not worried about it. Therefore, we end quantitative tightening, and to ensure there's ample liquidity in the system, we're going to start quantitative easing. I think actually that underneath it all, the Fed must be very, very concerned about the tech bubble, about that bursting, about the Bitcoin bubble, the consequences of that bursting. I don't know to what extent they take indications of the gold price going higher and silver price going higher, and what that might mean. They've had all that sort of sound money stuff drummed out of them, in effect. But I think they do actually see the US economy stagnating and therefore needing monetary support. Now, they're going about it completely the wrong way, but, it's irrelevant. That's the way they do it. So on that basis, I think, there is a big change, and it is going to be very, very inflationary. I think that's the key point to understand. Inflationary in the sense that, and I always prefer to look at it this way, inflationary in the sense that what will happen is that the dollar's purchasing power will decline a lot more than people think in 2026. So I think 2025 gives us the background to that. I actually don't share the Fed's analysis on this. I think there is ample liquidity in the system. The problem is that banks are getting worried about extending credit. And so that's the real issue. And the idea of reducing interest rates and doing QT and therefore flooding the bank's balance sheets with the most liquid form of deposits possible, i.e. reserves at the Fed, is not going to be the solution. It really is not. Banks, I think, are, if you just listen to Jamie Dimon, what he's been saying, banks see this environment as being not at all friendly. And the other thing, of course, is that as far as the Treasury is concerned, they have a problem because the only debt that's really selling is very short-term debt, which actually tells us that global investors see the Fed sliding into a debt trap. What's the right rate for a 10-year bond or a 30-year bond? I know what the market's saying, but the market is, if you like, in a sort of stasis on this. But if the Treasury really tried to test it, I think you'd find that yields would start going up quite dramatically. Why? Because they reflect the risk, if you like, inherent in investing in long-term US Treasury bonds. Now, everything else takes its tune from that, including equities. What we've seen in US Treasuries is a consolidation phase from about 2022, after that very, very sharp rise, following the economy coming back post-COVID. It looks to me, there are signs that yields are breaking out higher. The Japanese yield is going higher, and Japan is if you like, not being very helpful, because with its bond yields rising, they are now getting sort of attractive to Japanese institutions, the pension funds, insurance companies, and so on and so forth. The reason that they are the largest holders of US treasuries is because they were getting superior returns there compared with domestic bond markets. Now that's changing. The gap is closing. Furthermore, with interest rates rising, and presumably we'll get a rise in Japanese rates in the next day or two, which is all discounted, admittedly. But with those rates rising, the carry trade is no longer so profitable. In other words, the return on the carry trade is no longer really sufficient to cover the currency risk. So putting the whole thing together, Besant at the US Treasury can see a problem down the line. So what will QE do? Well, QE basically, what will happen, I think, is that the Fed will be buying short-term T-bills in the market, which bolsters the reserves of the banks on its balance sheet, which, looked another way from the bank's concern, means that their deposits rise, and they will effectively take those deposits and use them to buy US Treasuries. So all this is about funding US Treasuries at the moment. I think that, the real problem which we now face is that as these bond yields, the long end, begin rising again, that'll undermine the equity bubble. And we're already seeing the equity markets looking tired, let's put it that way.
Let's set the stage, honestly, without the sugarcoating you get from CNBC-approved economists who still think inflation is a weather pattern. The year 2025 wasn't just another chapter in the monetary saga. It was the year gold front-ran the inevitable collapse in the purchasing power of the US dollar. Gold didn't wait for the Fed to admit the truth. Gold didn't need a press conference, or a dot plot, or one of Powell's trademark "we're committed to data dependence" lullabies. Gold looked at the system, looked at the debt, looked at the liquidity traps, and said, "Nope, I'm going first." And when gold moves first, it's telegraphing something. It always has. It's the canary, the signal flare, the prelude. When gold starts running while the Fed is still pretending that inflation is contained, it means the dollar's death is already baked in. It's just that the mainstream hasn't noticed the oven is on fire. The situation entering 2026 and 2027 is not normal volatility, not business cycle stuff, not typical tightening to easing policy pivots. This is the front edge of a complete monetary unraveling. And the people who still believe the Fed can thread this needle are either delusional or heavily invested in making sure you stay delusional. Let's start with the geopolitics, because those are no longer background noise. Those aren't headwinds. They are the new architecture of global economic reality. The relationship between the United States and China is not deteriorating. It's divorcing. And unlike a divorce between two actual humans, where some kind of settlement is eventually forced, this divorce is happening between the world's largest exporter and the world's largest debtor. One has minerals, energy infrastructure, manufacturing capacity, and savings. The other has, TikTok bans, inflationary budgets, and an addiction to debt rolling. China has taken the breakup personally. They have responded in the most strategic way imaginable. They have begun hoarding their critical resources. Silver? No longer flowing freely out of China. Rare earths? Tightened. Antimony? Controlled. Cobalt? Restricted. Lithium? Stockpiled. And here's the key point. This didn't happen because they suddenly decided silver was magical. It happened because China finally understood what the West pretended not to notice. Silver was being artificially depressed for decades by the Western pricing mechanism. If a commodity is truly abundant, you don't need to restrict exports. You don't need to declare it strategic. You certainly don't need to tell the world, we're keeping more for ourselves. By late 2025, China's tone shifted from subtlety to outright declaration. We will prioritize domestic silver ownership. That single sentence was more important than half of the FOMC minutes released that year. The EU followed. The United States followed. Suddenly, silver was upgraded everywhere from shiny industrial afterthought to strategic metal. This wasn't coincidence. This was recognition. And so the entire base metal sector, which had been completely ignored in the AI bull run narrative, started to move sharply. Copper, nickel, tin, antimony, rare earths, they all began breaking out of long-term ranges in late 2025. Meanwhile, the Fed, the ECB, and the Bank of England were pretending inflation was tamed because CPI was massaged into looking like a sleeping puppy rather than a starving wolf. But here's the thing. Commodities saw through the lie. Gold saw through the lie. Silver saw through it most violently of all. The irony is that central banks still don't understand what gold's rise means. These are people who genuinely think inflation is caused by the consumer buying too many things. They think inflation begins with spending, not the expansion of the money supply. They think debasement is a conspiracy theory, and that the dollar has value because the Fed says it does. They believe CPI more than they believe the markets. So here we are in early 2026. The Fed has essentially waved the white flag on inflation. They didn't say it literally, but actions speak louder than Powell's voice, which is impressive because his voice can put trees to sleep. They announced the end of quantitative tightening. They signaled renewed quantitative easing. They tried to spin it as ensuring liquidity. But translation is simple. They gave up. They cannot tame inflation without blowing up the bond market. They cannot support the bond market without reigniting inflation. Therefore, they chose inflation. This is why gold front-ran everything in 2025. This is why silver is going parabolic now. This is why the monetary metals are behaving as if someone flipped a switch from slow burn to hyper mode. Now let's talk about where this goes next. The Fed's narrative is that there is not enough liquidity in the system and that banks need support. But that's not true. There is plenty of liquidity. The problem is not liquidity, it's confidence. Banks aren't refusing to lend because they lack reserves. They're refusing because they know something the Fed won't say out loud. The US economy in 2026 is a credit time bomb. Look at what Jamie Dimon said last year. Strip away his calm delivery and polished CEO tone, and here's the subtext. We're terrified to extend credit. The system looks unstable. That's what banks care about, insolvency risk, and they see it rising. Look at the treasury market. This is critical. Only short-term treasury debt is selling. Investors will touch a 1-month T-bill, maybe a 3-month T-bill, but the 10-year, the 30-year, those buyers have vanished. Why? Because those bonds represent long-term exposure to a currency whose purchasing power is in terminal decline. If you were a foreign investor, would you buy a 30-year bond from a country running a $3 trillion deficit, rolling $10 trillion a year in maturities, and openly inflating? Of course not. Foreign appetite is gone. And the biggest holder of treasuries, Japan, is quietly pulling back. Why? Because Japanese government bond yields are rising. Japanese pension funds and insurers no longer need US bonds for yield. They can get yield at home. The carry trade is dying. The yen is weakening. The risk is rising. Japan simply cannot justify its massive treasury exposure anymore. So what happens when the treasury market runs out of buyers? QE happens. Forced QE, not optional QE. Not let's stimulate QE. QE for survival. And every round of QE now accelerates the dollar's decline. Let me put this plainly for our viewers. 2026 is the year the dollar's purchasing power takes a visible, undeniable, irreversible plunge. The Fed will pretend it's transitory again. They'll blame supply chains again. They'll blame energy again. But the simple truth is that something snapped in 2025. And there is no policy tool that can reverse it. The Treasury can keep issuing. The Fed can keep printing. But the world no longer trusts the narrative. And that's why the bond market is the real battlefield of 2026. Not stocks, not crypto, not tech, not real estate. When long-term yields rise past a certain point, and we crossed the early markers already, it starts undermining the equity bubble. you're already seeing the cracks. Tech stocks looking exhausted, market breadth weakening, retail investors pulling back, leveraged funds quietly reducing exposure.